So this is the part of the show that I guess I talk about every show, where we discuss what I believe is important for individual investors to consider before you make your investment decisions over the next 1 to 2 weeks. And today we're going to talk about perhaps a topic that we tend to touch on quite often, which is what the Fed is saying, Fed speak, if you will. Today at 2 p.m., the minutes of the last Fed meeting will be released, and it is important. We're also going to touch on asset mix or asset management, portfolio mix. Should you be thinking about bonds today as part of your portfolio? And third, or last but not least, dividend stocks. You know, if everyone's talking about a pullback or a recession in 2023, how are investors going to make money? Well, maybe dividend stocks are the answer. So I want to touch on all those three things. And so we'll start off with the Fed. As I said earlier, the Fed at 2 p.m. will release the minutes of their last meeting. They're going to discuss basically, what they said in that meeting, where they think the economy is right now. And I think it's important for individual investors to understand what they're saying. And I think we have a few quotes by the Fed as well. And what we're noticing is that even though some of the officials in the U.S., as the Federal Reserve is in the U.S., of course, even though they all are saying that they have to continue to raise interest rates, and the Bank of Canada is saying the same thing, they're all starting to talk about slowing down the interest rate increases. So instead of raising interest rates 75 basis points, they're talking about perhaps raising it only 50 basis points, let's say for the month of December. Bank of Canada is talking the same way. And so here you see, pausing is off the table right now. It's not even part of the discussion. What is part of the discussion is slowing the pace of increases. So that was Mary Daly, the San Francisco Fed. And then you have Lyle Brainerd, who is the vice chair, who holds a little more weight. I think it would probably be appropriate soon to move to a slower pace of rate increases. So the stock market likes this. Whenever we hear a Fed official talk about slowing down the pace of increases, the market gets excited and moves to the upside. Now, make no mistake about it, 50 basis point increase is still a big increase. Prior to this year, pretty much the only increase, 25 points. And now we're starting to see 50 or consider 50 basis points as a slowdown in increases. So we've come a long way. I guess in the US, they've increased as much as 75 points. And here in Canada, we actually had one meeting where the Bank of Canada raised a full percentage point. So if we start to go now 50 and eventually 25, that would mean to me and most investors that we're coming closer to the end of this higher interest rate cycle than we are towards the beginning. And I always say higher for longer right now, because these interest rates will probably remain at these levels, what they consider restrictive levels, they meaning the Federal Reserve and Bank of Canada, for some time to come. So don't look for interest rates to be cut anytime soon unless we start to see a deep recession. If Canada and or the US were to go into more of a deeper recession next year, then perhaps the Fed and Bank of Canada may turn to cutting rates. But their credibility is on the line, make no mistake about it. And so if they start cutting next year after raising so much this year, I think a lot of people would question their credibility more so than they're already doing right now. So understanding what the Fed is saying, the Federal Reserve in the US, is probably even more important than what the Bank of Canada is saying to your portfolios at this time. The second point that I wanted to touch on is portfolio or asset mix, asset management. I'm getting a lot of questions talking or asking me about, should we be having or owning more bonds in our portfolios? Bonds today, you could pick up a very short-term bond, less than 3 years, paying in and around 5% interest. Now, keep in mind, when you factor out or take away taxes that you're going to pay on the interest that you earn, if the product is held outside of a registered plan like an RSP or a tax-free savings account, and factoring in inflation in our country here, which is 6.9%, how much of the gains do you have left? Well, the answer is nothing. You actually would still have a negative rate of return. So when people talk to me about asset mix, portfolio mix, how much they should have in bonds versus stocks, it's a discussion we need to have and is very important because people still have to understand that fixed income right now is still not helping to grow your wealth. It is there to protect your wealth, but not necessarily to grow it. So if you do have money parked in some fixed income right now, it is a part of your portfolio that you know is, for the most part, not going to go down if the stock market goes down, especially if you're buying good quality bonds. And I like to buy, my bonds are all investment grade, as we call it, or A-rated bonds, because those are the ones that have the least chance for default, if you will. So owning bonds, owning good quality bonds, paying 5%, I believe, can become more and more as part of a diversified portfolio, as long as investors understand that that is not the part of their portfolio that's going to give them any growth. At this point in time, with inflation still in and around 7%, it's very difficult to make money on these types of investments. The third topic for this show, for this week, this segment, that I think is important before you make your investment decisions going forward, is one we've talked about, I think, in the past, or I've spoken about many times on TV or on radio about. And these are your dividend stocks, your dividend payers. And I have a chart that clearly shows that if you're invested in dividend paying investments and those dividends are reinvested over time, you clearly will see that your returns are significantly higher. And so when you have an environment, and there's the chart right there, you're looking at growth in price only. So this would be, let's say you owned a stock over the last, it looks like, I'm trying to see the chart, I don't have my glasses on, but over the last 30 years or so. And you see here how much growth you would get. And then the darker line shows you how much growth you would have, or how much gains you would have, if you bought dividend paying investments and had those dividends reinvested. So a substantial difference between the two. And if you do believe, and I do, that we are headed for, or perhaps already in, some sort of mild recession, dividend paying investments are a great idea, because you're getting paid something while you wait for the growth to happen later on down the road. So if you're investing in a name like Enbridge that are paying, 6%, and a little bit more on the Enbridge stock, you're making 6%. You may not see a lot of appreciation in their share price, but you're still making 6%. If those stocks were to rise, let's say, even just 5% for the year, well, that's 11% rate of return for the year, versus someone that maybe just owned a growth stock making 5%. So dividends are a very powerful instrument, and something that I think should be a part of everybody's portfolio if you're looking to grow your wealth over time. Now, last thing I will say about this topic is, I'm not saying, you don't need or you shouldn't own growth investments, because I think you need to own those as well. Names that I believe will grow even in a difficult environment, even in a slowing economy. I think you can still find growth names that will grow for you in value, go up and appreciate in value. So if you built a portfolio, this is for your equity component or your stock component, out of good quality growth names that are undervalued right now, plus adding in some dividend and growth names, so names that can grow in value but also pay a very good dividend, that to me would be a great recipe for success for all of us to grow our portfolios and our wealth, even in a recession or a mild recession, which we may fall into in the first few quarters of next year. According to the Bank of Canada, it is a possibility, but I still think your portfolio can grow. And always keep in mind, the stock market is looking forward, not behind, and the stock market is looking 6 to 12 months ahead. And so even though the economy, in January, when we get into January in the new year, might soften, stock market can still rally because it anticipates better times later on in 2023, which I believe we will see once again.